All right, let's dive in. Welcome to the deep dive. Today, we're tackling a really fundamental question for anyone thinking about building wealth long term.
Yeah, the big one. Real estate versus stocks.
Exactly. We've got this, well, stack of articles and notes here looking at the different characteristics, the opportunities, the risks for each one.
And our mission really is to cut through all that noise. We
Yeah.
want to pull out the most important stuff from this material, show you not just what makes them different, but how they can actually work together in your own strategy.
Right. It's not really about picking a winner, is it?
No, not at all. It's much more about understanding them so you can make choices that fit your goals, informed choices.
Yeah, moving past that one or the other thinking. You might actually find the best way forward is finding your right balance. Get ready. Because there are some insights here that might, well, make you rethink things a bit.
Definitely. It helps to just, define what we're actually talking about first.
Sure.
So when the sources talk about real estate investment,
They mean physical property, right? Land, buildings.
yeah, tangible stuff. And that covers a lot from, say, houses and apartments you might rent out.
To big office buildings or warehouses, even industrial sites. And the money comes from basically the value going up over time appreciation and rent checks.
Right. Stocks, though, totally different beast. They're securities. They represent owning a slice of a company.
So you literally own a tiny part of that business.
Exactly. And their value. It's not tied to a physical thing in the same way. It bounces around based on, well, company performance, market buzz, the whole economy.
And we looked at the different kinds too, like common stock that usually gets you voting rights, maybe dividends.
Which is a share of the profits.
Right. And then preferred stock, which is often more about fixed dividends, less price swings, but usually no voting.
So comparing them isn't about saying this one's better. The real value, according to this material, is understanding the differences so you can be smarter about your choices.
Because it's easy to get swept up in headlines
Right?
and miss the fundamentals.
Totally. I mean, think about it. If you only do real estate, sure, you've got that tangible asset, maybe steady income, but you could miss out on, say, a tech stock boom.
And if you're only in stocks, you've got the growth potential, the liquidity,
Yeah.
but you're completely exposed if the market tanks.
So digging into their history, the risks, the tax stuff, the different ways they build wealth, that lets you tailor things. It really impacts your long-term financial picture.
And we'll see this idea pop up again and again, diversification, spreading things out.
Yeah, that seems to be the key thread for stable returns and, crucially, managing risk.
Okay, so historically, both have been pretty powerful wealth builders, right? Just in different ways.
Definitely. Real estate often gets tagged as the slow and steady accumulator. Properties tend to go up in value over decades, often keeping pace with inflation, sometimes a bit more.
The data we saw pointed to maybe, 3-4% average appreciation per year long term?
Something like that. And when you combine that steady growth with rental income, that's a solid recipe. There's a great example in the notes, actually.
Oh,
A local couple, they bought a house maybe 15 years back
yeah.
for around $200,000. It was in an area just starting to take off.
Okay.
Well, with the market improving and some upgrades they did, that house is now worth closer to $400,000.
Wow. Doubled.
Pretty much. But here's the kicker. They also turned the basement into a rental unit.
Ah, smart.
Yeah.
Extra income stream.
Exactly. So that cash flow wasn't just pocket money. It added this layer of stability on top of their equity growth. And it highlights another big thing in real estate.
Leverage.
Leverage. Using a mortgage lets you control a much bigger asset than your down payment alone would allow.
So when that $200,000 house went up, their return on their actual cash invested was way higher.
Right, because the growth is on the whole property value. So appreciation potential, rental cash flow, and those tax breaks, mortgage interest, property taxes, they're all big parts of the real estate picture.
Now, the stock market, it's got a different kind of allure. Faster growth potential, sometimes really dramatic growth. Looking at something like the S&P 500, the long-term average returns, even after inflation, have been, somewhere between 7 and 10% a year.
Historically, yeah, in that ballpark. And that kind of growth, especially when it compounds, is incredibly powerful over time.
There was that classic example, right? Investing, say, $5,000 when you're 25, and just leaving it alone until you're 65, assuming maybe an 8% return each year.
It could potentially grow to over $1 million.
Just from that initial $5,000, it really shows you the power of compounding.
And stocks have that big liquidity advantage, too. Selling a house takes time, months sometimes.
Yeah, paperwork, showings.
Right. Stocks. You can usually buy or sell them almost instantly online.
Yeah.
Lets you react fast.
Plus, it's so much more accessible now. You don't need a fortune to start. Lots of platforms let you begin with pretty small amounts.
So you've got real estate offering stability, tangible assets, and stocks offering that higher growth potential, liquidity, easy diversification. Finding that balance lets you tap into both strengths.
Which naturally brings us to risk. And
Right.
because, let's face it, neither is risk-free. They just have different kinds of risks.
Exactly. The stock market is, well, famous for its volatility. Prices can swing wildly, quickly, based on news, politics, even just one company's earnings report.
Yeah, I remember reading about an investment in some tech startup. It shot up like 150% really fast after a product launch. Super exciting, right?
Sounds amazing.
But then, boom, an earnings report came out that wasn't great, and it crashed like 40%, just like that. A real reminder of that short-term risk.
Real estate, on the other hand, it tends to be more stable. Values move, sure, but usually slower, more gradually.
There's that physical asset value, and people always need a place to live, which helps keep rental income fairly steady.
Yeah, think about someone owning a rental in a decent neighborhood. Even if overall property values dip a bit in a recession, they're likely still collecting rent because, well, tenants need housing. That provides a kind of stability stocks don't always have.
So that difference in volatility, that's really why diversification is so key, isn't it?
Absolutely critical. Because of those different risks, spreading your money across both helps protect you.
So if stocks are having a rough time, the stability from your real estate can kind of cushion the blow.
Exactly, and vice versa. If the property market slows down, maybe your stocks are still growing and keeping your overall wealth on track.
So the benefits are, what, less overall risk
Right. Potentially better returns overall by blending growth and stability.
and more ways to invest, like those REITs you mentioned, real estate investment trusts. They trade like stocks but invest in property.
Yeah. It just reinforces how using real estate stability with stocks growth isn't just spreading risk, it's building a more resilient path to wealth.
Okay, let's shift gears a bit. Taxes, always fun, but crucial here because they're treated very differently.
Oh, hugely different.
Yeah.
And understanding this can seriously impact your actual take-home returns.
Real estate seems to have some pretty attractive tax angles. The sources really emphasize this as part of the strategy.
For sure. First big one, mortgage interest deduction. On investment properties, you can usually write off the interest you pay on the loan. That lowers your taxable income, especially early on when more of your payment is interest.
And then there's depreciation. That's a weird one.
It is a bit strange.
Ah.
Basically, the tax rules let you deduct a portion of the building's cost over time, like 27 and a half years for residential, as if it's wearing out.
Even if the property value is actually going up.
Even then, it's a paper deduction, non-cash, but it reduces your taxable income. It's pretty powerful.
Okay, what else?
The 1031 exchange. This is big for active investors. It lets you sell one investment property and roll the profit into buying another similar one without paying capital gains tax right away. You defer the tax.
So it encourages reinvesting and growing your portfolio.
Exactly. Plus, all those operating expenses, repairs, management fees, insurance, even travel if it's necessary for the property, those are generally deductible too.
I saw an example where a first-year landlord deducted thousands in expenses. That really helps cash flow.
Definitely. Now, stocks, the tax picture can feel a bit less friendly sometimes.
Yeah.
The main thing is capital gains tax when you sell for a profit.
Right, and the timing matters a lot there. Short-term versus long-term.
Huge difference. Sell stock you've held less than a year, and that profit is taxed at your regular income rate, which is usually higher.
But hold it over a year, and it qualifies for lower long-term capital gains rates. Big incentive to hold on.
Yeah, there was a story about someone selling just like a week before the 1-year mark
Ouch!
and realizing they'd pay way more tax because of it. Timing is key.
And dividends, even if you reinvest them.
Generally taxable income in the year you receive them, yeah. There are different rates for qualified versus non-qualified dividends. Qualified usually get better treatment, but it's still taxed.
One thing you can do with stocks, though, is tax loss harvesting.
Right. That's where you intentionally sell investments that have lost value. You realize the loss, and you can use that loss to cancel out capital gains you might have elsewhere. It can even offset a bit of your regular income sometimes. It's a way to manage your tax bill strategically.
So bottom line, understanding the tax rules for both is just essential. It's as important as the growth potential.
Absolutely.
Yeah.
Okay, so how do you actually use these assets to build wealth? Let's talk strategies.
With real estate, we already touched on leverage. That seems like a really unique aspect.
It really is. Using borrowed money, a mortgage, Lets you buy an asset worth way more than your initial cash investment.
Like that $50,000 down payment getting you control of a $200,000 property,
Exactly. And if that property goes up 20%, that's a $40,000 gain.
which is an 80% return on your 50K, not just 20%. That's the power of leverage.
Right. So the advantages are potentially much higher returns on your invested capital, building equity as you pay the mortgage down, and getting into bigger investments sooner.
But gotta be careful, right? Leverage cuts both ways.
Oh, absolutely. If values fall or you can't cover the mortgage payments with rent, you can get into trouble fast. Managing debt wisely is critical.
Okay, what about stocks? What are the specific wealth building strategies there? Less hands-on, maybe?
Often, yeah.
Hmm.
Especially things like passive income from dividend stocks,
So instead of dealing with tenants and toilets,
right? You just own shares in companies that send you a check, basically a share of their profits. It could
yeah.
be a pretty steady cash flow.
And you can just reinvest those dividends to buy more shares, right? That compounding effect again.
Precisely. We saw examples of people starting early, getting those quarterly dividends, and just letting them automatically buy more stock. Over time, that really snowballs. Your investment grows, and your income from it grows too.
So the pluses there are the continuous cash flow, easy reinvestment, and yeah, way less active management typically.
So you see, they both offer these powerful but quite different ways to build wealth. Real estate leverage can boost returns. Stock dividends offer passive income and compounding. Understanding how to use these is key for balance.
So speaking of balance, what do the financial advisors say? What's the general consensus from the experts in the materials?
Well, the consistent message is that both are really crucial parts of a well-rounded strategy. It's almost never presented as pick one.
I liked the analogy one advisor used, real estate as a sturdy tree.
Yeah, the tree provides stability, steady shade, like appreciation and rent. And stocks are like vibrant flowers. They can be beautiful, grow fast, but they're more vulnerable to, storms, market volatility. Need more attention then.
Makes sense. So their main points are usually about
Diversification, number one. Mixing assets to lower risk, stabilize returns. Aligning investments with your specific goals. Maybe combining appreciating real estate with some growth stocks for the long haul. And considering your investment timeline. Real estate's generally a longer game than stocks.
Okay, so practically speaking, how does someone figure out their mix? What are the tips?
First step, always, is assess your risk tolerance. How much fluctuation can you stomach? If you prefer stability, maybe lean more towards real estate. If you're okay with more ups and downs for potentially higher returns, maybe more stocks.
And within stocks, don't put all your eggs in one sector basket either.
The point, diversify within stocks too. Tech, healthcare, consumer goods, whatever. Don't be overly concentrated.
Setting clear goals seems vital too. Saving for retirement in 30 years is different from saving for a house down payment in 5.
Absolutely. Short-term versus long-term objectives really dictate your strategy. And this is important. Review your portfolio regularly.
Don't just set it and forget it.
Right. Markets change, your life changes. You need to check in, see how things are doing, make adjustments. One person learned this early on, staying informed and tweaking periodically, kept them on course.
And if buying actual property feels like too much,
Consider REITs. They give you real estate exposure, often in large projects, but trade like stocks, so they're liquid.
and finally, be smart about taxes. Use those retirement accounts for stocks when it makes sense. Take advantage of the real estate deductions.
Yeah. So combining these insights gives you a solid path. An advisor can really help personalize that roadmap for you.
It helps to see how this plays out in real life. The
Yeah.
sources had some case studies, right?
They did. For real estate, there was the story of Sarah and Tom. Started relatively small, bought their first place for $250K in an up-and-coming area.
Okay.
But they were proactive. They immediately started doing short-term rentals with part of it.
And that generated extra income.
Apparently about $30,000 in the first year alone,
Wow, that's serious cash flow.
which they then plowed into buying a second property.
Smart move, so they scaled up.
Exactly. And within about 5 years, their portfolio, those two properties, was worth over $800,000 between the appreciation and the ongoing rental income.
So what was their key? Just luck.
Doesn't sound like it. The story emphasized their strategy, picking the right location, actively managing and finding income streams, and constantly learning, going to seminars, networking. It shows how calculated risk and effort pays off in real estate.
Okay, and on the stock side, the obvious example is
Warren Buffett, yeah. Can't really talk stock success without mentioning him. His approach is pure value investing
Finding good companies that the market is undervaluing?
and holding them for the long term. That Coca-Cola investment from the 80s is a classic example. He saw the brand strength, the long-term potential, wasn't trying to time the market day to day.
So his principles are like buy and hold quality.
Focus on the fundamentals, earnings, management, competitive edge. Do your homework.
And keep your cool when the market goes crazy. Emotional discipline.
Crucial. And look at the result. Berkshire Hathaway, massive wealth creation over decades. Market cap over $600 billion now.
So, two very different stories. Sarah and Tom's hands-on real estate hustle, Buffett's patient, research-driven stock picking. Both worked.
Yeah, just they're a diverse path, but they all seem to involve planning, discipline, and continuous learning.
Okay, crystal ball time. What's the outlook? What trends are shaping the future for these two?
Well, for real estate, things are definitely evolving. Big social and economic shifts are having an impact. One huge one is the remote work trend.
Still going strong, yeah.
Seems like it has lasting effects.
Yeah.
People moving from pricey cities to suburbs or rural areas for more space, lower costs.
I know someone who did exactly that. Moved to a smaller town, needed a home office, didn't care about commute time anymore. That changes demand patterns.
Big time. Other key trends. Growing focus on sustainability, energy efficiency, solar panels, more prop tech virtual tours, maybe even blockchain for transactions down the line, the aging population needing different kinds of housing, and the ongoing challenge of affordable housing.
So understanding those shifts helps you spot where the opportunities might be.
Exactly. Now, the stock market forecast, it's always complex, but generally analysts seem cautiously optimistic. Maybe average returns in the 6–8% range over the next decade. But
Always is volatility.
always expect volatility. Sectors like tech could still see rapid growth, but they're also prone to corrections, especially with changes in interest rates or economic sentiment.
What are the big factors driving things?
Inflation and how central banks react is huge. Geopolitical stuff, trade wars, global instability, investment in new tech, AI, biotech, renewables, and just general market mood, investor confidence.
So it's a mix, opportunity, and challenge. Need to stay adaptable.
Adaptability and staying informed seem absolutely key for stock investors going forward.
Okay, so wrapping this all up, if there's one big takeaway from everything we've covered, it really seems to be diversification, doesn't it?
Absolutely. That theme just kept coming up. Putting both real estate and stocks in your strategy isn't just like an option. The material suggests it's pretty fundamental for resilience.
That old saying, don't put all your eggs in one basket. It's cliche, but it's true here.
Yeah, there was that personal story in the notes. Someone mentioned how during a stock market plunge, their rental income from property kept things stable. It reduced their stress, kept them on track financially because one part of their portfolio was buffering the other.
Makes perfect sense. So the key reasons for diversification are managing risk,
Spreading it out, aiming for more consistent returns overall.
balancing the highs and lows.
Right, and opening up more opportunities for growth across different areas.
So for you listening, thinking about your journey, what are the main action points?
Okay, distill down. First, keep learning. Educate yourself about both markets constantly.
Second, really know your risk tolerance. Get honest about what you can handle. That shapes your portfolio.
Third, think long-term. Avoid knee-jerk reactions to market noise. Focus on growth over time.
Fourth, use the tools smartly. Be careful with real estate leverage. Manage debt.
Fifth, check in regularly. Monitor your portfolio. Adjust it as markets or your life changes. Don't just set and forget.
And finally, embrace that balance. A smart mix of real estate and stocks seems like the best bet for capturing growth and weathering storms.
It really does seem to be the most effective path toward building that lasting wealth.
So here's something to think about as you move forward, based on everything we've discussed. How will your own personal comfort level with risk, combined with your specific long-term financial goals, ultimately shape the unique balance you decide to create between real estate and stocks on your path to financial well-being?